To set the context, as what I was saying earlier on before we dive into the content, we need to understand that in this environment today, there has been no precedence to this event. In fact, Warren Buffett was just quoted a couple of weeks ago at his AGM at Berkshire Hathaway, saying that he himself also isn't sure of how this is going to play out. So on that note, looking back may not be the best reference to moving forward. Now, for those who are property seminar fans, if you've attended a lot of property talks, we tend to always look back a lot on past data, transactions, past performance and all that. I'm a person who's a little bit more curious than that, so I would like to find out a little bit more about why these things were happening, to understand the fundamental drivers of it, so that perhaps we can take that context and put it in today's context and realize how it can affect the future as well. So this afternoon session really is for all of you to really develop some insight into the data that I'll be presenting, but more importantly also helping you to form a decision-making framework that will give you the foresight to make well-informed decisions down the line. Okay, so today's highlights. We'll start off with the matrix. This is something that is simple. Before we start off on the content, I want to help you to frame your mind to look at what we can control and what we cannot control. So a simple matrix there. Then we'll look at the fundamentals from an economics background. I always like to look at things from the simplistics of demand and supply, so we'll explore that in greater detail. And then very importantly as well in Singapore, we cannot just look at things from a local context. As a global city, we need to look at things also from a global context. So we'll be studying a little bit more about that. And last but not least is really to hit the road, for the tires to hit the road and talk about investment fundamentals. What really makes the magic and the power of real estate investment? Many people just think it's simply buying low and selling high. There are a lot of nuances that we need to understand, and I'm there to share with you some of the principles and criteria that I picked up along the way. And very importantly, we'll look at a case study, which is has fictitious characters, but is based very much on a real story of any average Singaporean. All right, so let's launch right into it. The Matrix first, not the movie, but very often we get a lot of calls, and I realize Singaporeans are a very savvy bunch. We actually have a lot of information available on our heads, but the issue very often comes down to analysis paralysis. So I've got a little simple framework here. It's not my framework. It's actually a known and unknown framework, which is used very much in design thinking. And I use it because it's very easy to use, and I hope to share it with you to help you also understand a better framework, maybe perhaps to help you to make easier decision making after that. All right, so we look at unknowns. We have got a lot of questions in our heads. How long is the pandemic going to be? Are there more black swan events coming? Will it be a V-shaped recovery? To be honest, if we focus so much time on finding out the answers to these questions, we're never actually going to be able to take action, because these are questions that only time can tell. So we must be very clear when we are making decisions about what are the things that are unknown. And the other thing also that we always look out for is known unknowns. Are prices going to come down? We know that market may make some adjustments. Is it the right time to buy? When is the right time to buy? You know that these are relevant questions to ask, but you may not necessarily know how to answer them. All right, then we look at the known columns, the most obvious things, all the data and stats available for you to read through. But without the experience and the wisdom, data is simply data. If you don't know how to make sense of it, then you also have an issue there. Right, so we're going to spend a bit of time today in this portion. All right. The known knowns are very often presented in property seminars already. Today, let's deal with this, the unknown knowns, things that are underlying, things that may not be so obvious, but things that are actually going to be very important that you may not know how to answer yet. All right, so basically it's again looking at the demand-supply dynamics, our regulatory framework in Singapore, and of course, the investment criterion to decide if real estate investment is really for you. So first things first, let's talk about people. Let us remember at the end of the day, as much as we all like our homes to make us money, we have to remember homes were built for people. Okay, so we always got to actually focus back on people. So looking at that, these are data that you can find actually from SingStat. Okay, so I'm just putting some wisdom into it, and hopefully you will find some alignment of the data that I present as well. Now, looking at this population pyramid in Singapore, the first thing for us to note is that our average age in Singapore now is 41.1, close to where I am, right? So I'm actually pretty much the typical Singaporean median age percentile guy, all right, going through the same life phases as many contemporaries of mine. The other thing to note very interestingly as well is the bulk of the population, over 66% of it, is actually between the ages of 20 all the way to 60-ish, right? And the more important question for us to ask here is, between this age group of 20 to 60, what is the typical phase of a person's life here? And it is career growth and aspiration. Okay, so remember this thing, because at the end of the day, when you are in that phase of life, a lot of things happen. Things are always in flux. And the most important thing is now you have the ability to make your own decisions on how you want to create your own life. Okay, So going on to that, this is another very popular topic people like to bring up as well. Oh, Singapore is an aging population. We're going to go into decline and stuff like that. Yes, you can see from the data here, very straightforward. From 13.5 ratio of 65 years and older today, we've dropped to just a much lower percentage, right? So yes, indeed, we have a declining OH support ratio, but we also have to realize this, that the bulk of this aging population are people like my dad, who are the baby boomers, who were part of the pioneer generation in Singapore. So they may not be economically productive. However, they have been through a tremendous period of growth in Singapore, and they may still be economically quite productive in terms of spending or changing their lifestyles, going into retirement, and also most importantly, requiring housing needs, which I will demonstrate in our later slides. You see, at the end of the day, if all the kids have moved out, a 4,000 square feet house, or even a 1,200 square feet, 5-bedroom, 5-room flat, for instance, may be a little bit too much already to handle. So there is this thing called right sizing as well. Okay, so we need to think about this market segment, even though it's a big segment and it's sitting at the top, and it's very easy for us to discount it as a economically non-productive segment. Right sizing comes into play here. So we need to think about this segment as well when it comes to real estate. Okay, so with this graph, you will see very interestingly as well, as much as our population rates have not risen much over the years, that's why the government is always trying to give us incentives to pop out more babies. But the interesting stat here really is resident households, resident household formations. Now within each house, you actually have perhaps less people. You can see here the average household size has shrunk. And so there's a diminishing household size as each household decides to fragment itself into different other households. A family of 4, the 2 sons have grown up, each have their own jobs. One gets married, he buys his own HDB flat. The other son is single, he buys his own apartment and he moves out. So this actually adds on to the demand element of actually real estate in Singapore, even though the population may not be growing, but because of the shrinking household size and the diminishing household sizes, but the increase in the resident household formations, you actually see a demand being formed as well as a fundamental demand for real estate in Singapore. And the very important thing here to note also as well is housing mobility. Okay, in many other countries, this was an area of interest in my master's work. We talk about housing mobility. Many other countries, like I tell people, sometimes you have a farmland, you sell your farmland for a certain price, you want to move to the city, you cannot even afford to move to the city. The next step up is a big jump, it's almost a quantum leap. But I will show you in a case study later how an average Joe in Singapore jumps onto the bandwagon of real estate investing so easily, and how that shifts everybody's perspective of what we call housing mobility. Okay, so now we move on to employment. This is also a big topic that's brought up recently because, of course, we're all worried about jobs, to be honest. And most of the time when a lot of clients ask me, hey, how is, like the property market going to be? My simple answer always is, this is my bellwether. I look at employment more than anything else. I will explain why in my next slide. But the thing we need to know about employment at this juncture, right? We don't know how this is going to pan out. So I cannot promise what's going to change, but this is an important bellwether for us to consider. At this moment, a lot of the unemployment rates have been quite contained into certain more direct sectors, and also perhaps in also the sectors of the foreign workers. So the local job sector is still pretty much well contained and protected. Why? Because the government has been pushing in so much of our savings back into the system to ensure that companies are kept afloat, and more importantly, jobs are kept intact. And this is what we hear from top level. For me, at this level, I talk to my clients who are business owners and all that. Majority of them are not thinking of adjusting any headcount at the moment and are doing what they can as well to keep jobs going. Right? So for now, this remains constant, but this is something for us to look out for. But if things change within the next 2 months or so, perhaps for the better or for the worse, this is something we need to take a look at. Now, why is employment so important in terms of real estate? I want to give some backdrop here as well. We talk about drops of employment all the time, but we have to realize actually Singapore government has been very busy providing a lot more jobs in the last 10 years. All right, so we are actually at a very high level now. For us to take a little hit as well and a little adjustment may not be so consequential on the economy as a whole. But again, why is jobs so important? Because in real estate, jobs equals income, incomes equals to the ability to get a mortgage. And a mortgage is what affords people a house, very simply said. I put the nominal median income there for us to consider because that will be applied to our case study later, about 4,000 for a month, all right? The thing I want to share here, very important for us to look at, is you can see on the aspirational curve of age how income changes and fluxes throughout a person's age, right? The more important thing is to see where income starts to really plateau, which is in the later part of 50s and all that. But in the stages between 20 years old to about 50, the growth of income is very high. Now, this has a tremendous effect also if you have a large population in this age group who is also riding this wave, and that also will add on to demand factors, right? I have another stat here which is very fascinating. So this is from Business Insider, and it's taking a look at it referencing US kind of typical demographic. You will notice here, in the US, most people will buy a home at 40 if they can afford it. In Singapore, you realize that our access to home ownership starts a lot earlier. Now, what does that mean? When you start a lot earlier, you get to build your equity and your growth a lot earlier. But the more important thing is you actually have a much longer runway after that. If you buy your house at 40, by the time you turn 50, you might say, I'm going to retire maybe 5 in 10 years time. I might not think of upgrading or doing anything drastic change in my life. Whereas the person who starts home ownership in late 20s has a tremendous runway to look forward. And that's where they start to have aspirational plans and shifts. So that's very important in terms of a market fundamental for demand as well. Okay. Now, let's look at this as well from a home ownership perspective. This is also a very important stat for us to consider. Again, when majority of the population is hedged into real estate, there's a very strong base of equity already locked into the system that grows with inflationary pressures. So at any one time, you can make decisions without actually compromising on your life when you've got a large base already set up in your own home. And 90% of us in Singapore have home ownership, right? So it's an equity hedge and an equity growth. And this also forms a very strong established domestic demand. If you have half of the population only owning their own houses, it's very hard for the 50% of the market to transact within one cell. Whereas when you have 90% of the population as the market, there's a lot of chances for upsizing, right sizing, and changes and shifts to happen. So the market is has a lot more volume. All right. And again, because all of us are hedged in so early and we are hedged in, our capital grows along the way, it encourages us constantly to think about aspirational needs and motivations. Just to provide some context, in case you think Singapore home ownership rates are not high enough, let us compare them to other first-tier cities in the world. All right, looking at the US and the UK and Australia, they're all hovering around 65%, significantly less than us. All right, then you go down to even more advanced economies like Japan and Germany, who are even below 60%. And in a place like Hong Kong, which we are all very familiar with, being very close to us, home ownership rates there are less than 50%. As a 28, 29-year-old who's working your butt out and thinking of buying a house, you might actually give up that dream, seeing how fast the house prices are appreciating and knowing that you may never be able to afford it. Therefore, you continue staying with your parents and buying expensive meals and going on nice holidays because owning a home is out of the question. Different story in Singapore. That's something for us to think about. Okay, so understanding it from a global context, now let's look at foreign demand, because this is another issue that's constantly brought up by a lot of Singaporeans. Oh, it's always the foreigners coming here to drive up our prices. You know, we Singaporeans are being left out and left behind and stuff like that. Let's look at the figures and get this sorted. So I'm taking a 2-year span between 2010 to 2012 before the full brunt of the measures came in 2013 to adjust the ABSD to prevent foreign ownership. Back then, we had only 70% of Singaporeans in terms of the residential transactions happening every year, and 13.4% foreigners. Now let's fast forward to today, the most recent stats between 2018 to 2020. You realize that stat has changed quite significantly, right? Firstly, Singaporean percentage has gone up from 70% all the way to almost 80%. We are taking market dominance here. Foreigners from 13.4% has dropped to 5.5%, right? So what can we infer from this data is that the effectiveness of the cooling measures is very high. It's really prevented a lot of foreigners from coming in, okay? And more importantly, again, we look back at domestic demand. Very significant, still a fundamental driver for whatever is happening in the real estate realm in Singapore, okay? And our last slide on demand today, we are going to look at annual absorption, all right? Now, let's not get too confused with the figures on the right, just to keep things simple, and we can move on. The average 10-year absorption rate per annum, excluding ECs and landed, are approximately about 21,000. But let's dive in a bit deeper into new sales, because right now the market is on fever with new sales. A lot of people are wondering about new sales. So let's look at absorption rate purely on a new sales basis. Okay, so new sale absorption rates, pre-measures, all right, were between 14,000 to 19,000 per annum. Now, let's look at new sales post-measures, 7,000 to 9,000 units per annum. This is the natural market absorption, and this is with why we want to study pre-measures and post-measures is because we have to understand now that currently the market is being suppressed by measures. So we are operating under those conditions, therefore those figures are perhaps more pertinent to us to look at rather than looking at what it used to be. Okay, so keep these figures in mind. Now we move on to talk actually about properties, supply. I start off with a very interesting graph. I will further elaborate on this. A lot of people's common questions is Singapore is going to be in a deep oversupply situation. We're building so many buildings. We had a run-up of so many launches coming up and all that. Valid points to be brought up. It all seems overwhelming, but let us look at the data properly. This is the first time you're probably going to see this data side by side as a comparison. Firstly, we need to understand in Singapore, supply is by a very robust regulatory framework. Okay, what I mean is that the government is actually the master landowner of Singapore, and a lot of the primary sales of sites in Singapore are involved from the government land sales. And this is very, very tightly regulated. At any one time that they feel there's an oversupply, they cut back straight away on the land tenders. And then they put the lands out that are available for tender, then the developers will decide whether the market forces or the market demand is there for them to want to partake in the tender. If not, nothing happens. So that's the primary market of land sales. What about the secondary market of land sales? En bloc sales, also a very big thing, but completely almost to a zero activity now, thanks to the government measures that came in 2018 that put a complete halt to it, for good reason. I'm going to put an en bloc figure here just for a bit of context. En bloc sales started to be very healthy in 2017. In 2016, we had 7 en bloc deals. In 2017, we moved up to 32. And in 2018, we had 35 land sales. Billions of dollars of land being sold to developers. And this provides some context also to actually the supply that's coming in. You fast forward 3 to 4 years, you will see the supply of these en bloc sales all coming in. As you can see, the expected pipeline of completion in 21, 22, and 23 down the line. And this is the point of contention for a lot of people. They're always asking, oh dear, it looks like we really have a massive pipeline of units actually coming into completion. Now let's look at some very good level data from URA, often not released. But we need to, before that I provide some context, you will see that even in 2014 and 2016 and all that, you can see that the supply levels are actually way more than we are today. So, but never mind, let's not look back again, let's look at today. This is the data of the units that have been sold end of Q1 2020. This does not include March and April figures as well, but let's look at that and go through them slowly. You will see, because the whole thing about property is it's never about instant response to the market. You might demand the property today, but the property might only be ready in 3 years' time. And in Singapore, because we are aspirational, we often plan ahead. 3 years' time, my property, my MOP. 2 years' time, I might want to move out. I think my kids need to go to a school. I will plan ahead. So therefore, you can see here, the bought-up ratio has already occurred even 4 years down the line because these are properties that are actually even launched today already. So in year 2020, at current, we have 3,918 units, excluding the 270 over units that we sold in April during the CB period. We are very close to the completed absorption rate already. Okay, so looking forward, the more important thing is going forward. How does it look? 2021. The more important numbers I want you guys to focus on is the green numbers here, which are the units sold, and then the numbers at the bottom bars, which are the units going to be ready. All right, so 9,600 units versus 6,000, which means we have a shortfall of 3,000. Do you remember what the annual absorption rate is for new sales under post measures? 6,000 to 7,000. We only have 3,000 to go through. Oversupply, something to think about. Moving on to 2022, 12,000 units available, 5,002. We have about 6,000 units left. Compare back to the post measures annual absorption rate for new sales, also covered. 2023, a little bit closer, 12,000 units minus 4,400 units. We've still got about maybe 7,000 to 8,000 units, but still very conceivable and not very far off from where our natural rate of absorption is for new sales in post measures. And remember, this is post measures with the current measures in place. Then as you can see, because the government came down really hard in 2018 on the ABSD for developers, look at the land supply in 2024. You can see this is a very cyclical thing, but we are covered for the next 3 years. And in 2024, what's going to happen? We better hope that they may moderate their measures soon to allow more developers to come in to buy land to provide more pipeline for 2024. Otherwise, we may even have a shortage in 2024, right? So this is all very important to know. You can see how the framework affects the demand in terms of like land acquisitions and all that on the supply side. But the more important thing for us to note as a Singaporean or even an overseas investor who's tuning in today, we have complete transparency of information of our inventory, current and future. Then now we dive down deeper into the supply. Now you know that there's X amount of units, the housing supply in Singapore, over 1 million houses in Singapore, of which they are broken down into the public segment, which is the majority of the base, which forms over 80 to 90% of where most Singaporeans live, the HDB flats, right, public housing. And then you have the private market, which is further segmented into private condominiums and of course landed estates, right? Now, the thing to note here from this graph is to see from a 10-year context that in 10 years, there's been quite a huge shift from public housing into private housing. Again, something to do with the aspirational needs of the aspirational Singaporean, right? You can see how the figures have changed. Back in 2009, 83.6% of the housing supply was actually HDBs. Today, it's fallen to 78.6%. Then the other more important figure to note is private properties used to occupy only 10% of our housing supply in Singapore. Today, it's 16.2%. All right, that's quite a tremendous growth in just 10 years. All right, so we really need to keep that whole context about what I talked about aspirational demand and this whole shift and why we study the HDB market as well is so important. I, as an agent who is always doing more deals on the high-end side, landed properties and private, also pay a tremendously close attention to the HDB base because it is still, after all, the largest base of housing supply in Singapore. And because add that up with the housing mobility, the shifts that happen between the different classes of property are very, very vital for us to take note of. Okay, 1 and 2 room flats increase in numbers. Again, you know that as we age, some people right size. And the more important thing also, as we know, family sizes are shrinking. Your son can now go out to buy his own HDB flat as a single even at 35 years old and buy a smaller HDB flat. So you see here from this interesting data point that I get as well from HDB, that between 2008 and 2013, these are the latest figures that I have. I think it's even going to be more drastic today. But you can see the median ages on this right-hand columns here changing. What used to be 58, and in just 5 years, the median age also has dropped to 55 for 2 rooms. So you know that the younger people at the same time are also accessing public property on a smaller scale. Okay, so knowing that HDB forms a very large base of the housing supply situation in Singapore, this is something very important we need to look at. MOP period. For overseas investors who are tuning in, just to give you some context, in Singapore, when you buy public housing from HDB, you go to them and you buy it off the shelf. They call it BTO, built to order. All right. And one of the regulations that you have to adhere to buying into BTO is that you need to stay back for 5 years and not be able to sell it. So when you collect the keys, you have to stay there for 5 years, then you can sell it and put it back onto the resale market, the secondary market, and then you can move on from your life after that. Okay, so this is also a very important thing for us to take note of because as we already talked about aspirational demand in Singapore, a lot of us wanting to get out and move on with our lives, to get into the private estate because we are all in this age group now where it's all about aspiration. So very often you will see how this market actually drives the demand on the basis of Singapore, right? And more importantly, let us look at this here. I have put the graph on the same timeline here with regards to volume and as well as price line. Okay, so take note of the MOPs and also the MOP period that we are in. We are in an unprecedented time of MOP units coming into the market as well. When you tally that to our price trend below, do you see some correlation there? Right, this is something for us to also really think about. Very often we just quote this when we are at show flats and we see a number of people all upgrading and coming in from HDB flats, young couples, 32 years old and all that coming in. It's so easy to just say, oh, we see this observation. But now when you see that observation and you put it right next to the data, it shows something quite serious here for us to consider, right? And the more important thing for us to note here is that this has a domino effect as well on the rest of the market because of the seamlessness of the housing mobility. Somebody who comes out from a HDB straight away can jump into private market and then starts to have effect on the private market already. And this is such a big base that is coming into a much smaller base. So you can imagine the kind of demand pressures that are coming from this drive alone. Okay, so now we look at the regulatory framework. We know a lot about the demand patterns of Singapore. We know a lot about the supply nuances of Singapore now. Then let's talk about regulatory framework. Why is this important? Because this is the glue that binds the market of demand and supply together, and we really need to have this considered as well. And what better way to start off than with everybody's favorite graph, which is our price line of Singapore's property in the last 10 years, coupled with the relentless slew of cooling measures in place. You will see here the vertical lines in black, in brown, and red. All those are the cooling measures that have been coming in relentlessly since 2009. For the last 10 years, government has really been trying to regulate the market. Okay, so we are in a state where the government doesn't really allow too much freedom in the market, but it's for a good mandate, if you ask me, because it's about keeping sustainable growth and, more importantly, stability. Okay, we are not in a position where the government is very happy seeing 5% growth per quarter leading to 20% growth per year. You'll be assured there's going to be an ABSD 5 or 6 coming in when that happens. Okay, so the thing is, we know that in Singapore, the market is very regulated. And at the end of the day, you can see how it's affected volume. You will see the blue graphs, bars in the background, which affects a lot of us agents, because agents for us, we operate on volume, not so much the pricing. So it's hit the business quite bad, but you can see in 2017 and 2018, the volume really ramped up again, right? All the way to 2018, where another slew of measures came in. And today you have foreigners paying 20 plus 4% stamp duty and Singaporeans paying 12 plus 4, 16% to the government for a second property. Okay, a lot of people complain, say, oh, these government measures are so imposing on us and all that, you know, when will they moderate it? Very common questions. I'm sure you have those questions in your mind as well. My question back to you is this. Can you imagine Singapore without the measures today? Knowing what the demand fundamentals are from a local context, and I'm not even talking about a global context yet. We will approach that after this. Okay, and the thing is, you will realize also measures have been always reactionary rather than proactive measures. The government always allows the market to play out first, and then they'll use the measures to control and regulate the market. So reactionary, when do you think the government will moderate the measures? I suppose they'll moderate the measures when they start seeing that the market is taking a bit of weakness. Having said that, the reason why all of you are tuning in today and why we still have so many calls is because we know there are so many of you out there just waiting to come in again. And if the government makes an announcement today that Singaporean can buy a second home not for 12% ABSD, but we moderate it to 5%, what's going to happen? Do you want to wait for that to happen before you decide on real estate? That would be the question that you want to think about as well. All right, and looking at monetary policy here, very important as well. We are in an age of extremely low interest rates, and that's really fueling a lot of liquidity into the system. Cheap money is in abundance. Cheap money is looking for assets to acquire. All right, and this is the best time that you can buy a property at interest rates from as low as 1.2%. It will really make your buying power a bit larger and also your monthly payments quite more manageable. Right, so in terms of that, we have that on our side. Then also affecting the monetary policy here is, of course, our Forex. Now, this is something also for us to think about from a global context. We were a bit puzzled recently also during the CB. We still had clients from other parts of the world actually still buying into Singapore now when things are so shaky and uncertain, but we still had overseas investors wanting to even pay 20% ABSD into Singapore. And you wonder why. Then when you look at this graph, you will know why. Because recently MAS has been doing quite a lot of relaxing in terms of our Forex. And for those who've been doing quite a bit of Amazon shopping as well during your CB period, I think when the credit card comes, you will get a little bit of a shock. Stuff that you bought in US dollars and all that, you will see quite a bit of a disparity there from what you could see probably 3 or 4 months ago. Okay, so all these things are affecting, again, the market context. And now that we're talking about things from a global context, how do we measure up? This is very important because this was brought to me by one of my clients who actually came to Singapore in 2018 to look for property. She's from North Asia, and she has houses in London, she has houses in SF, Sydney, Shanghai, and Taiwan and Hong Kong. And a lot of these places, that was her price context, and Singapore was also considered expensive. And those places have been experiencing quite strong growth since after getting out of Lehman Brothers post-2010, 2011, a lot of things swung around. You will see here, from 2011 to 2018, majority of these cities here, and some of you may have properties there already, have experienced tremendous growth. So as a foreigner coming into Singapore and looking at Singapore and thinking Singapore is high price, and coming from the context that the rest of the world has also been seeing a lot of upward trajectory, she was waiting for Singapore market to crash. She came back in 2018 for 3 times, and each time she came back, her units were sold, and she said, how come the market hasn't crashed yet, right? The thing is, you have to realize, I'm going to put a little highlight here on Singapore. You remember our measures. Ever since 2013, the market has been moving sidelines for many, many years until 2018. And 2018 is when we really picked up. Looking back at the demand factors, you understand why from the MOP perspective and all that now. So you see, it's so important for a foreigner to also have the right context of a local context when looking overseas to invest. And this is something I also want to share with you because a lot of Singaporeans now, because of ABSD, are also looking to invest overseas. That's why I want to spend some time talking about considerations for cross-border investing. All right, very often it's so easy to just buy something because it's cheap, right? A lot of people love to go to Koh Samui, Bangkok, buy a nice property on Sukhumvit and all that because it's a lot more affordable for us. But price context is, again, something I'll elaborate more on later. First, we need to look at barriers to entry. Like in Singapore's perspective, overseas investor looking to Singapore will think about 20% ABSD, quite high, right? But the more interest, aside from the taxations and the cost of entry, is actually the impositions for barriers to entry as well. In Singapore, foreigners can only buy private properties. For us, let's say we go to Australia, we can only buy off the plan. We go to countries like Indonesia or Thailand, we need a local proxy. We can't even put a property in our name. You know, so you have to consider these things. Would you want to give a name to a property that you just spent 300,000 Singapore dollars on to somebody that you maybe just met half an hour ago? Something to think about. In Singapore, we don't have that problem. In fact, we have a very robust framework, again, on land legislation and most importantly, land registry. There's complete transparency and clear title and ownership to a piece of land that you acquire. There's been stories before, people buy a piece of land in this country, they go there, they bring their excavators there, waiting to tear down the building to start to build a new hotel. This old lady comes along with a title deed and says, this is my father's land. And everything has to stop. So these are things we need to consider, and you can understand now why from a global context, Singapore is a very attractive place. Then there's holding costs. The simplicity of real estate is buy low, sell high, but what happens in between the sustaining period? That's also something very important for us to consider. This is just to keep it simple. In Singapore, you can make a yield of maybe about slightly over 3%, and you are basically almost able to cover and not go into negative gearing every month, which means that your outgoings are almost on par with your incoming. If you rent out the property for 3,000 plus your interest payments, plus your maintenance fee, or that you just at slightly over 3%, you are actually able to match. So $0 out of your pocket every month. In certain countries, holding costs becomes a very huge cost, like in the States or in Australia, where agents demand management fees, there's council fees, a lot of these ancillary fees, that even when you make 5 to 6% yield, you are barely even able to cover your gearing. So you end up going to negative gearing even at 5 to 6% hold. Okay, so this is something to also really think about. Barriers to exit and costs, very, very important, because buying property doesn't make you money, it's selling the property that makes you the money. So we also need to look at barriers to exit. In Singapore, the only barrier for foreigners would probably be SSD also. You have to wait for 3 years. But in this context where we know we're keeping the growth trend very sustained, you probably need to hold on to your property a little bit longer than 3 years. So the SSD period doesn't become really relevant anymore. But in many other countries, you've got capital gains tax. You sell all the money that comes out. How are you even going to bring the money back to Singapore? That's another question that we never think about as well. What are some of these ancillary costs of funds being transferred back and stuff like that? So we always have to think about that from multiple perspectives in terms of entry, holding, and exit. And then, of course, country risks. Singapore stands very highly here again. Stable governance, and the governance mandate is really about stability. And in this day, you can see how dynamic the markets are. People who have money, the one thing that they are always really looking for is a safe haven where stability is really at its peak. And Singapore is one of the places that you really cannot beat for that, right? You don't want to be also investing in a country where 3 years later, there's a new government in power and the legislation has completely changed on foreign ownership and stuff like that. You'll be left in the dead if that happens, right? So country risk is something very important to think about as well. Last but not least, Forex. Simple example of what I talked about buying on Amazon just now. If you had bought a property and you didn't finance it over there and you paid full cash, converting your Singapore dollars into the foreign currency, just to put it into a very simple example, if you had bought a Malaysian property, say 5 years ago when the exchange rate was 2.75, today at almost 3, you have almost lost about 15% on your property already without even having to do anything, because your money straight away under Forex has diluted quite substantially, right? So Forex is something we need to think about. And this is one of the factors why I would also usually not want to look overseas, okay? You can see here legislation that doesn't stop foreign ownership. I mean, here we are stopping it, we are putting the brakes on it. In some countries, they say, oh, there's nothing we can do. So things like that, we really need to keep a lookout for. And price context. Of all the things about foreign investment, this is the most important thing. Price context. Earlier on, I was talking about, how someone coming in from overseas, looking at Singapore, thinking Singapore is, well, going to crash as well, because the context of market performance has been based on a global context. But we have to realize that every country these days also behaves differently, especially in a place like Singapore where we have a lot of regulatory control. Okay, so Singaporeans always say, oh, these foreigners come here and buy up properties and bring up our prices so high. But hey, do you realize we are a bit hypocritical sometimes? Because that is what we've been doing across the causeway. Now, this is a terrible graph if you ask me. This is the median house price trend in Johor. And just barely 10 years ago, it used to hover just north of 150,000 ringgit. Today, thanks to all the new products that have been launched there, the median house price is up 3 times, 300%. Okay? The question we got to ask ourselves is, have incomes there gone up that much? Has the population grown that much to support these kind of prices? Where is the domestic economy in relation to this price trend, right? And this is something that we really need to think about, because what we think, we've always been made fun of in Singapore, that when we go to Thailand, Malaysia, we are like birds. We go everywhere, we say cheap, 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 cheap. Even today, looking at this graph, you might be looking at Malaysia property and say, wow, in Johor, 300 ringgit, that's like buying a Toyota Corolla in Singapore. I think I can afford that, it's cheap. But what does it mean to the local context over there? And the question is, why is that important? Because again, the domestic demand has to support this price as well. So you buy your house at 300,000 ringgit and then you choose to sell it 5 years later, only realizing that most of the locals can only still afford houses at around 100,000 ringgit. What happens to your asset then? So this, you can see how vital it is to think about when going overseas. And to keep it all very simple and sum this part up is, if somebody has to fly thousands of miles and spend thousands of dollars on a beautiful Four Seasons ballroom to sell you a property, why isn't the property selling out back home? That's something you've got to ask yourself. We end up now at our final part of this webinar today, where we are going to let the tires hit the ground and we're going to talk about investing. Some of the financially savvy clients out there, I'm sure this will be familiar to you already, but be patient with me. I think it's good to revisit this to really remember the premise of why we get into real estate investment in the first place. Now, this was a very interesting chart that was shared last week in our head of research webinar on the profitability of Singaporean properties. And you can see here, beautiful figures. Majority of people made profits. Profits are also very handsome to look at. But now we want to get deeper into profits, because a $300,000 profit on a $30 million house may not mean anything at all, right? So let's provide some context to it and really dive down deep into what really matters when it comes to investing in real estate, which is just these two words for you to remember: equity and leverage. For those who don't understand, equity is basically the seed money, or the money that you have to put into an investment, and leverage is simply the bank loan. So the beauty of real estate, right, is that with your amount of money, your base equity that you have, say you have $250,000, you can today go out to buy $250,000 of stocks or equities, or you can choose to say, I'm going to use the $250,000 to not buy $250,000 of stocks, but I'll use the $250,000 as a 25% down payment to buy a $1 million property, because of the power of leverage. Now, what leverage simply means is, because of the ability to have a loan, you're now able to buy something 4 times the amount of money that you have. And technically speaking, the bank does own 75% charge on the property, right? But you see, the best part about why you take a bank loan for a property is these two things. Firstly, it expands your buying power, but the other thing that it buys you is time, right? That old $750,000 that you needed, you didn't have up front, but now the bank is willing to give it to you up front, and you are only willing, and you're agreeing to pay them a small little amount for the next 30 years every month. Doesn't send shocks to the systems, right? It's very contractual, it's quite straightforward. And with this time, that's when you wait for your property to appreciate and then you sell. And this is where the magic, the true magic of it comes through. Even though the bank owns technically 75% of your property, they own 0% of the profits that you make and you take out to put back in your bank account at the end of the day. And this is the most important fact on why you want to get into real estate investing. So let's launch straight into a case, a very local case, something that a lot of you can relate to, and I want you to understand because this case will present you a very clear picture of why Singapore is where it is today. So 2018, go back 2 years, Kelvin got on his knees, and in Singapore, typically when somebody wants to propose to their girlfriend or boyfriend or whatever, they will always get on their knees and instead of asking, will you marry me, it's always, should we book a HDB flat? That is the most unromantic way to propose to somebody in Singapore, but that is a try and tested way. And in a way, it's good coming from a real estate perspective. I'll show you why. So here they are, 28, 29 years old. Let's look at their financials. They've been working for about 4 to 5 years. Kelvin has about $18,000 cash, 36,000 CPF for working about 4 years. Julie, 20,000 cash, 48,000 CPF. So combined together, they have about $38,000 cash and 84,000 CPF. All right, and I'm just taking the median income here again, 4,500 fiancé, $9,000 combined a month. They can actually take a loan of in excess of 1 million, but here in this case, they're just buying a HDB flat, in this case for $400,000. They go to HDB, they find, oh, Paya Lebar has a new estate coming up. Kelvin's dad lives nearby Paya Lebar. He wants to be near the family, also make use of some of the subsidies that they have for living close to parents. He buys a 4NG 93 square meter unit at Paya Lebar for $400,000. These are market rates. You can qualify them also on HDB. And here comes the more important component, again, what we talked about, equity and leverage. So the cash and CPF that they need, essentially for a $400,000 purchase, is about $100,000. Okay, in this case, they can actually break it down because in Singapore, the other power that we have, that we can use is our CPF, right? So they've got 84,000 combined. They can, out of the $100,000, they actually, of down payment, they can actually use 80% of it from their CPF because they have enough in their CPF combined. So they only come out with $20,000 cash today, 80,000 from their CPF, and with the $20,000 cash that they come out, they still got $18,000 left in their savings for a rainy day or for furniture, for renovations. Pay the stamp duty. So the actual capital that comes out today of their pocket to buy this house is $106,000, of which 80,000 comes from CPF. All right, 75% leverage, 25 years, 2%, $300,000 loan is about $1,200 and $72 a month. Okay, quite straightforward. Now we move on to the exciting bit. MOP is over, 2023, we fast forward. Julie now gets on her knees and then she goes to her little darling and she says, darling, shall we move to a nicer house with swimming pools and private open spaces so you and Koko can run about? Here they are, 5 years later, husband and wife, 33 and 34 years old with 2 little ones in tow, looking to upsize or to look for a better space. Now, they put their HDB on the market, and again, these are market rates. They sell their 4NG at $678,000. You say, wow, in 5 years, they made $278,000. That's quite a handsome profit, isn't it? Yes, return on investment is 12.6% per annum. This will beat most of the stock returns out there. That's quite powerful, isn't it? So property, if you start early, you take a bit of time, you can see the return on investment is quite strong. But what I want to share with you here, ladies and gentlemen, today, really is not about return on investment because that's not the game of real estate. You have to remember, on day one, I came up with $26,000 cash. Today, after I pay the bank back, by the way, these figures here of loan repayments and all that are powered by Home Loan Wiz. I just want to introduce you to one of the leading mortgage brokers in Singapore, who also happens to be run by my brother, who has a CFA level 3, so I trust him with the numbers more than myself. So these numbers are, a lot of them are powered by him. So looking through here, more importantly, at year 5, when we repay the banks back, you pay back the bank after selling 678,000, paying your selling cost of 15K, and then paying the bank back $250,000, including of the penalties and the loan interest. You come up to an after-sale equity of 410,000. You started off at 106,600. And then don't forget, in Singapore, when you use your CPF to buy property, your CPF also has to be repaid, but it comes back into your own account with interest. We use 80,000 now based on 2.5% interest over the last 5 years. You have to put back $90,000 into your CPF, but it is still your money. Now, the more important thing here for us to look at again is not ROI, ROE. 77% per annum, return on equity. Your $26,000 cash today, I will show you how much it's become in the next slide. But your return on equity, the actual seed money that you actually put down, that was your money, not the bank's money, into this property, has grown 77% per annum. This excludes the monthly payment, and say if you want to consider the monthly payments at $1,272 a month, I have amortized it backwards into the present value of about $72,000 in 2018. you would still get a 46.6% return on equity. This is the power of real estate, not ROI, ROE. Where else in the world do we grant young Singaporeans or young people in the country this kind of power of return on their equity? If you're young in any other country, you'll be lucky if you can invest in some stocks, maybe make you 4%, 5%, 6% a year. You'll be lucky. But in this country, the base of our population that starts off with gets to make this kind of money. Let's look at the financials at 2023. Remember how much cash we started off? 26,000. I paid the bank back. I put the money back in my OA, in my CPF. Today in 2023, 5 years later, this couple who was scraping the bottom of the barrel with all their life savings, today has $335,000 coming out from the sale of their HDB. And let's be conservative of savings of the last 5 years, $1,000 each per month, accumulating $60,000 of cash savings in the last 5 years. Add that together with the equity that they took out to run their home. They are now walking into DBS Treasures and the bankers are there waiting to start a relationship with them. That's why you notice today when you go to DBS Treasures, it's so crowded to get your free cup of coffee because an average Singaporean rises to the ranks so quickly to develop this kind of return and join the ranks of people in the upper segment 5 years later, right? So now let's look at here, 2023, with all that money, what are you going to do with that money, right? Let's look at it in the context of what can I buy for my next home. Here we explore the average income now from $9,000 going up to $10,000. That's $500 per person per month for the last 5 years. That's $100 a year. It's not a lot to begin with, but I'll just be very conservative just to show the example. $10,000 a month, now they can take a bank loan of up to 1.3. Coupled with their $330,000 cash, $60,000, and don't forget CPF. CPF has also been accumulating for the last 5 years because they use cash to pay the money installments. Today, this couple at 33, 34 years old is going out into the market and walking into a swanky District 9 showroom and saying, what can I buy with $1.9 million? And this is just a very conservative estimate, as you can see from my figures. This is the power of Singapore. And only in Singapore do we get this opportunity. And you have to realize when somebody like that goes out into the market, if they don't go and buy brand new, they will go and say, okay, I won't spend 1.9 million. I'll go and buy a $1.6 million resale property. And so they will buy it from some guy who bought this property maybe 3 years ago, 4 years ago for 1.2 million. Today selling it for 1.5 or 1.6 million. And he's also having the same scenario where he's cashing out and looking at his bank account going, oh, I've got now more buying power and I'm only 39 years old. I've still got quite a bit of time for me. I'm going to buy a 4-bedroom apartment, or maybe now I can buy a $2.5 million 4-bedroom apartment instead. So you see how this has a chain effect, starting right at the beginning of the base, going up the ranks of the aspirational properties and how each class of property gets affected along the way and how seamless it is for housing mobility to happen in Singapore, right? So let's look at this very important last slide on investments. We talked about this as a very nice story and all that already, but I want to bring us back to the ground, to the golden question people always ask, when is the right time to buy property? My simplistic answer to you always is, as soon as you can afford it. Why is that so? Because let's look at this very simple leverage analysis created also by Home Loan Wiz. Let's look at a couple 35 years old, so they can borrow until 65, combined income 14K a month. And I want to show you here, looking at the trending down graph, that represents the loan quantum that they can borrow based on their 14K income from age 35 to 60. Do you see what a difference the age makes? The more important thing, if you look to the bar graphs on the right, you will see the monthly payments get more expensive as the loans get smaller on the simplistic value of time. Because in Singapore, MAS regulation only allows us to borrow to age 65 based on the maximum loan ratio that we want to go for LTV. So you can see from the age of 35, a couple earning 14K can borrow 1.8 million. But as they approach, every 5 to 10 years, that loan quantum drops, which then reduces your buying potential, right? So your capital gets smaller and smaller, then your equity might be, you might require actually more equity to put down. So then that comes up to our last slide here on this investment, which is property investment for me? Now you can see the effects and how powerful on the combination and the marriage of equity and leverage is when it comes to investing in properties. This is actually just a little screenshot from my SGX trading platform. these are some of the stocks that I hold. You will see the dividend yields highlighted in orange on the right. You can see that there are a lot of instruments. Why I bring this up is because very often I get a lot of people asking me, hey, Justin, unREITs also giving very good yields. Shouldn't I invest in that more than property? There's never a right or wrong answer, but my simplistic answer to it really is there's definitely always an instrument out there that can give you more optimal returns. But how optimal it is really based upon your ability to have that base equity and, of course, the leverage that you have. If you are a 60-year-old male today, and then you're coming into me and say, hey, Justin, I feel like buying a property, but my REITs are also giving me 7 to 8%. I'm very happy with it. I have about $1 million. Should I go and buy a property or not? If you're going to buy a property today based on the sustained growth because of the measures that we have in place to grow 2-3% a year, and your $1 million is going to be stuck there because you can't borrow money, say you're 65 years old, then of course I would say, please go and play your REITs. You're definitely going to have a much better thing. So the questions we need to ask ourselves here really is, am I able to optimize my equity for better returns in other instruments based on the fact that if I have the time to leverage optimally? As I grow towards, you saw from the last slide, towards 65, my ability to leverage really diminishes. So time is of the essence. If you are belonging to the later part of the graph, it might be very difficult for you to actually consider real estate as an investment. However, if you have somebody's time that you can leverage on, which is very popular today, fathers in their late 60s are saying, my son just got his first job, or he's already in his mid-30s, I'm going to help him to buy a house, or I want to buy a house under his name. Then you can leverage on somebody else's time to make your leverage potential go up again, and then make real estate or property investment again very feasible for you. All right. So let's end off here with our closing notes. Sorry, I've been, I think, talking quite a bit already, but we'll just finish up here real quick. On our closing notes, I just want to go through what we've been through today. So we've worked with the matrix. It's very important for you to have a clear head when it comes to real estate investing. And I think the design thinking framework of the knowns and unknowns is very useful. Next time, if you ever get into analysis paralysis, sit down and actually pen it down to really realize what are the things that you can work with. And then we established very much about the fundamentals of demand in Singapore based on our base population, our aspirational needs, and where we are in terms of our demographic pattern at the moment. And then also we talked about how regulated our framework of supply is in Singapore, and the big base of MOP, minimum occupation period, has an effect on the market demand as well. Okay, then of course we talked about the uniqueness because Singapore is not a closed economy. When an open economy, is very important for us to look at how Singapore is looked at upon as well from a global context, and for us also to look at when we look outside for overseas investments. And last but not least, we went through the investment fundamentals of really knowing equity and leverage and how we can optimize it based on time, and seeing how powerful the MOP market and the BTO market has an effect on the majority of the market because of housing mobility in Singapore. And of course, finishing off is property investment for you, right? So property investment may not be for everybody, but the more important thing for us to really always look back upon is time really is of the essence. We might think that we have a lot of time going ahead, but under MAS ruling, you can see our time and opportunity for that leverage diminishes through time. And the worst part is that you cannot buy it back with all the money in the world, okay? So my advice is really start young, start early, and it's not rocket science, and it's not a quick flip. You have to be disciplined and committed to the program of investment and really look down on fundamentals. And predicting the rain doesn't count, according to Warren Buffett. Building the ark does. All this information, sitting through webinars and knowing all this stuff doesn't really matter if you don't put your tires on the ground, all right? So I will end my seminar here just to bring on a little segment about what's happening next week. We've got two very charismatic speakers who are the IC for one of our top selling projects now as well. They're going to come in to talk a bit about more applicable strategies for you to find silver linings and turn crises into opportunities. So now that you've got all the knowledge and know-how and also the criteria to know whether you are in good shape for property investments, we give you the chance to find your applications here next week. With that, I end off the seminar, and I hope all of you have found this afternoon insightful and helpful. And we are now going to go to our Q&A session. Thank you.
Thank you, Justin, for that sharing. Seeing all the rave reviews and comments coming in, I'm sure our listeners found your take on the defensive play very refreshing and reaffirming to their future property investment plans. It's now time for the eagerly awaited Q&A. A quick reminder for listeners tuning in, if you have any questions, all you have to do is click on the Q&A option at the bottom of the screen and type in your questions. While more questions are coming in, maybe I'll just quickly share an article I read this morning. CEO World magazine did a study of the world's best countries to invest in or do business in 2020. And in that list, Singapore topped the list for being the top most attractive nation for investors and business people. So maybe, Justin, I want to start off with my own personal question. You shared Singapore's position in the global context. So do you think with the pandemic, do you see a resurgence of foreigners coming in to buy properties? What is your take on the situation now?
Okay, so we look at the data and the fundamentals again. Data has shown how the cooling measures have been so effective in culling all of the overseas demand. Yet at the same time, looking at the overseas criteria that I presented to you earlier on, you can understand why there's still so much attraction in Singapore, and therefore the measures actually may need to stay. That's why I asked a question earlier on, can you imagine Singapore without measures today? Can you imagine what it would be like if a foreigner today, coming from a very different price context, looks at Singapore and says, I no longer have to pay 20% stamp duty. What's going to happen to that? Right, so we know what the fundamentals are in play, the regulatory framework that's keeping the fundamentals in play as well. That's something for us to look out. We don't know how that's going to change, but we do know that we still remain very attractive. And at any one time, should the market forces change, regulatory framework allows them to be nimble enough to also moderate the trickle of demand that comes in.
Right, great, thanks. We have a few questions coming in from the listeners themselves. So this is more generic, I would say, from Mr. Tan. How has the property landscape changed due to the pandemic? I think this is quite a common question now. So what is your position on this, Justin?
I think that's a very good question. Everybody is looking for things to change, but actually I can say that actually the market has not changed much structurally. What has really changed that really surprised me as well was actually in the last month. I think the biggest change will happen actually in the sales and marketing and transactions of real estate. In a month where all of us are supposed to be locked down at home, where real estate is a non-essential service, we had 270 houses sold from the comfort of their own homes, right? So I think the thing that has really changed today is that people are getting so comfortable with the integrity of the system in Singapore that they are able to actually trust the system enough to actually buy a multi-million-dollar item online without having to meet the agent, without having even to see the property, and have their trust and faith in the system to know that they know what they're getting. I think that is the biggest change to me, which is the biggest surprise, because I was expecting to have a nice vacation, but I'm sure all of you know, for us agents, it's not been a quiet month, right? So I think that has been the biggest change. Perhaps the other change is always buying sentiments, right? Buying sentiments, we are always very emotionally turbulent because the environment is also quite turbulent, right? So being in a dynamic situation that we are today, buying sentiments change quite a bit. But I want to tell people also that buying sentiments are also very temporal. As much as we are all fearful today, all of us are seated here today for an hour listening to this guy drone because we are all still sitting on the sidelines very interested in real estate. And I can tell you that that's what worries me. Knowing that there are still so many people on the side, I don't think the stamp duty measures are going to be moderated because all of you are still waiting to bounce back inside the market, right? Because sentiment is very temporal. I remember back in 2008, where places like Rivergate, which used to be 2000 PSF, crashed to 2002. I had people coming to me saying, Justin, tolong, please help me dump the property. I pay you 3-4% commission. I need to dump it at 1,002 per square foot. And 1.5 years later, nothing was sold. The guy calls me back and said, wow, the markets are rallying. You know what, Justin, forget, hold it off. I think I'm going to wait. And good thing he waited because today, I mean, River Place is going about 2,002 per square foot, 2,004 per square foot. And yeah, so sentiments change. That's why it's very important why I did this webinar today, because I know all of us are a bit frantic, we're a bit worried and all that. It's so important for us to really look back at the basics and the fundamentals when we are in a situation of dynamic flux, right? So go back to the fundamentals again.
Okay, I have a lot of questions coming in. Some are really interesting, but due to time constraint, I'm just going to pick a few. This one's from Mike Lim. Can you comment on why new launches have overpaced resale market in Singapore? Is the premium in new launches justifiable? So yes, Justin.
Okay, I'll break this question down into two bits. You talk about premium first. Now, many people get very caught up with PSF when they talk about premium. Now, PSF has to be respected because new land rate acquisitions are higher than before. And the land rate acquisition in Singapore has only been in one trajectory, which is always going north, right? So we always have to respect the rise of PSF. But if you look at it very clearly, we always want to try to bring it back down to earth and look at quantums, because that's the most important thing for us to look at. So if you look at it from a quantum perspective, you will realize a lot of the new launches are actually not very much ahead of the market. In fact, some of them are even behind the market. A good example would be, say, one of my projects, Amber Park. You know, a two-bedroom on the opposite side is at one Amber, for instance, is going at about 1,009 per square foot. Of course, the being older, 14, 15 years old, the sizes are bigger and all that. But the price of that two-bedroom at one Amber is about 1.9 million transacted. At Amber Park, where everybody's saying, wow, you know, how can Amber Park be 2,004 per square foot? It's ridiculous. Our two-bedroom starts at 1.6 million. You see, so don't get so caught up with the PSF. You really got to get down deeper sometimes and not just listen to markets. Say, wow, PSF here got this price, got that price. You have to dive down deep, because the ultimate question I always pose this back to people when they talk about PSF is, when you go to a bank to loan money, like when I go to a bank to loan money, I said, hey, a banker, hey, this is my salary. Okay, Justin, I will loan you 1,600 per square foot. No, they loan you $1.6 million, right? That $1.6 million then comes back to you now as a consumer who's looking at a brand new launch and an older product, and then you decide for yourself, do I want to deploy 1.9 million into buying something that's 15 years old? Yes, I get more size. Or do I want to go something with a more lifestyle element, concierge service, towel service by the pool, stratosphere on level 22, I can jog above the cloud, stuff like that. So it comes back down to a lifestyle question. And having said that, that is why there's been such a big popularity on new launches, because new launches, developers here, I can tell you, they don't make a lot of money, right? Because the profit margins are thin, because the land price is very expensive. So they really, really have to do their utmost best to ensure that their product stands out to win the consumer's heart. And that is why today is so difficult to go to. Even for me right now, I'm also looking for something. You know, you look at the resale, oh, I can get like 200 square foot more for this 3-bedroom. But if I buy the older product, then I don't have this, I don't have that. Then it becomes a bit of a conundrum already, right? But having said that, again, all of us are very used to new things. You look again, going back to the MOP example, we bought a brand new HDB flat. Now you ask me to go and live in a 20-year-old apartment just because I get a little bit more space, I might think a little bit harder. I hope that answers your question.
Right, Justin, very well answered. I'm just going to get one more question. For other questions that are coming in we haven't answered, I know there's few specific questions or asking about Justin's slide. We will still answer your question specifically. The panelists will help you answer that. But I'm just going to sum up, because I've been reading all the questions. I think the general thing that our listeners want to know today is, a lot of them are living in a HDB, they're looking to upgrade, they have this certain budget. So Justin, in your opinion, what do you see is the hotspot now?
Okay, I think this is
where do we buy? What do you recommend? So we want to.
It's a word that's very big.
Down to business now. So
again, I won't answer the question too directly because I have my own biases. I'll be very aware of that and honest with you about that. I have my own criteria on what I look at. Okay, but just on a broad level, in Singapore, a lot of the land, again, on the primary sales segment is led by the GLS program. And the GLS program from the government is also very intuitive and intelligent. They know that in this area, there's going to be a lot of potential. Things are being built up, Paya Lebar region, Jurong West, and Exchange, you know, stuff like that. So on a broad level, actually in Singapore, you can't quite go wrong on looking. You don't have to be so specific about hotspots. But going back to what we talked about today, we have to understand where the demand drivers come from, because demand and aspirational demand is the thing that puts an upward pressure on prices. So you wanted to talk about a property being hotter is a place where it's most desired. So then we have to study and understand where the major MOP segments are, and then look beyond just saying that, oh, it's just purely in that area. Because many a times you have to realize when somebody's aspiring to get out of the HDB, they will usually want two things: move closer to three things: move closer to work, move closer to office, to maybe their parents, or move closer to town, move closer to kids' schools. right? So all these things play a very fine nuance, but the base of it comes from somewhere, but you have to study. So for instance, a lot of people say in the Northeast region is a huge region of MOP units. A lot of people coming down Northeast from Northeast. And that's why I'll share with you my own understanding of it. I noticed a lot of properties in the East Coast and a lot of properties in District 19 are really, really, really moving. Because people who have been living in the extreme east or northeast have always been taking the purple line down towards town or taking the green line down towards town. And as they aspire to move into private properties, they will naturally want to move closer towards work or office and towards town because it's more atas. For those who are foreigners joining into the atas means higher class, right? So if you look at that, then you look at the trends and how they move down the MRT lines coming on these two very powerful lines. And then you can decide maybe for yourself where the hotspots are. But again, going back to the high level, on the broad level, in Singapore, it's pretty much a very safe place to really hedge your bets. But then we want to get on the hotspots, meaning the places which are very desirable. I will always look at, again, fundamentally where the base of the demand is coming from. And don't forget, as that base comes from MOP pushing up into private, that private sector who's also selling to this MOP sector is going to push closer to the city and more aspirational goods along the way. I hope that answers your question.
Thank you, Justin. Thank you for your very thoughtful answers to all the questions. There are a few more questions coming that are directed specifically at you. I don't think we have time to go through them because we have already gone past the time limit. But I hope you can just stay back and maybe answer them in the Q&A section itself. That's all we have for today. A gentle reminder, if you'd like to obtain a copy of the presentation report, feel free to approach your representing OrangeTee and Thai agent for a copy. And also be sure to tune in to another OrangeTee and Thai Consumer Empowerment webinar session next Sunday, same time at 3 p.m. That really brings us to the end of today's session. I hope all of you found it as useful as I did. As I said earlier, for listeners who still have questions, we will keep the session open and we will try and address all the questions that were asked during the session. Thank you, everyone. Have a very beautiful, blessed Sunday evening. This is Ramesh, your MC, signing out till next weekend.
Thank you, everybody. See you soon and stay safe.
Thank you, Justin.